Welcome to our presentation on In Re Marriage of Ciprari. I am Kathryn Kirkland. If you are hearing a CH sound at the beginning of the pronunciation of Ciprari, that is the correct pronunciation. I am co-presenting in this program with Jim Schaefer. Our format is different from most presentations that you encounter. We will present the most important points in Justice Curry's appellate decision verbatim, but will omit full citations. Jim and I will periodically insert commentary to highlight important concepts for both the attorney and the family law forensic accountant. Illustrations will further help explain these concepts.
I am Jim Schaefer, a family law forensic accountant. I will be presenting practical considerations for the family law forensic accountant, with a view to assisting forensic accountants in preparing their reports and testimony at a settlement conference or an evidentiary hearing. Kathryn will expand on the law where appropriate and will provide strategy for counsel in presenting the evidence from the forensic accountant. In this presentation, we will only be dealing with the tracing portion of the case. We are ready to begin with Justice Curry's words. An off-screen avatar will read the relevant portions of the Ciprari decision. The graphics and commentary by Kathryn and me are not part of the decision.
Introduction. DeeDee and Joe married on September 16, 1995. The trial court fixed the date of separation as August 13, 2010, the date DeeDee commenced this marital dissolution proceeding. The marriage terminated pursuant to a judgment entered March 18, 2016, which attached the court's final statement of decision. On appeal from that judgment, DeeDee principally challenges the trial court's characterization of a majority of the cash and securities held in commingled accounts as Joe's separate property. As discussed more fully below, she attacks a detailed tracing analysis performed by Joe's expert witness, upon which the trial court relied. We conclude the tracing is valid and constitutes substantial evidence in support of the judgment. Discussion. Characterization of assets. The parties stipulated Joe entered the marriage with $2,053,573 of separate property. Of that amount, $873,953 was held in two Wells Fargo bank accounts. The trial court found the money held in the bank accounts was, essentially, gifted to the community, a finding neither party contests. On the date of the parties' marriage, Joe held the balance of his separate property, $1,179,620, in a brokerage account at Paine Webber. As is typical, the brokerage account had a cash component and an investment component. The account held $295,856 in cash and securities then valued at $883,764.30. In February 1996, Joe received a $244,696 bonus from his employer for work performed during the prior year. Because the parties had married during 1995, the bonus was partly separate property and partly community property. Nevertheless, Joe deposited the entire amount in his Paine Webber brokerage account. This was the first time that community and separate funds became commingled in the account. But it was far from the last.
The term commingled in this opinion is the legally correct term. Some people used mixed and commingled interchangeably. Those two words mean different things. Commingled specifically means an account which contains both community and separate property, but both types of property are identifiable. Funds in a mixed cannot be determined, despite the mnemonic of marriage of mix. Those funds, by law, are all community. We return to the opinion.
Throughout the marriage, Joe indiscriminately deposited portions of his salary, which was community property, into the Paine Webber account for and other commingled investment accounts he later opened. By the end of 2014, the combined balances in these commingled investment accounts equaled $6,910,568. How much, if any, of that sum was Joe's separate property, and how much was community property, is known as a characterization issue, and is the central issue in this case. Characterization refers to the process of classifying property as separate, community, or quasi-community.
Characterization of each asset and each debt must be determined before the court is able to divide the community estate. Division of the community estate is a global division, not an asset-by-asset or debt-by-debt process, even though the determination of the character of each asset and each debt is a step-by-step process. We return to the opinion.
Family Code Section 760 states the basic presumption that, except as otherwise provided by statute, all property acquired by a married person during marriage, while domiciled in California, is community property. Each spouse has a present, existing and equal interest in the community property. Section 751. On the other hand, property acquired before marriage, or after separation, or at any time by gift, bequest, devise, or descent, is separate property. Section 770, subbed A. 771. And the rents, issues, and profits of separate property also are separate property, whether earned before, during, or after marriage. Section 770, subbed A. 3. Except as otherwise provided by statute, neither spouse has any interest in the separate property of the other. Section 752. Thus, there is a general presumption that property acquired during marriage by either spouse other than by gift or inheritance is community property unless traceable to a separate property source. This is a rebuttable presumption affecting the burden of proof, hence it can be overcome by the party contesting community property status.
Although Justice Curry uses the term presumption, that is not accurate. Family Code Section 760 is a statute. It has no reference to any presumption in its language. However, Justice Curry is correct when he describes how the presumption works. Because Family Code Section 760 is essentially written in the negative, it functions like a presumption. If there is some evidence that changes the community property rule, then the character of the asset or debt may be different from community property. We return to the decision.
Since this general community property presumption is not a title presumption, virtually any credible evidence may be used to overcome it, including tracing the asset to a separate property source, showing an agreement or clear understanding between the parties regarding ownership status and presenting evidence the item was acquired as a gift. Of course, mere commingling of separate property in community property funds does not alter the status of the respective property interests, provided that the components of the commingled mass can be adequately traced to their separate property in community property sources. But if the separate property and community property interests have been commingled in such a manner that the respective contributions cannot be traced and identified, the entire commingled funds will be deemed community property pursuant to the general community property presumption of Section 760. At trial, Joe's forensic accountant testified he had conducted a detailed and comprehensive tracing of all the accounts, analyzing every transaction, including all deposits, purchases, payments of interest or dividends, transfers, and withdrawals. Although the tracing was lengthy and detailed, listing approximately 17,000 account entries in 23 accounts over almost 20 years, and consisting, along with various schedules, of 547 pages, it employed straightforward and readily understandable methods.
The amount of paperwork generated by this kind of extensive tracing is enormous. No judge wants to wade through several hundred pages of accounting details, especially ones which are commonly presented in single space and tiny type. For any kind of tracing report that requires many pages of detail, I recommend that the actual forensic report be printed in standard font size. In addition, prepare a chart for the settlement conference or evidentiary hearing that summarizes the essential facts of the tracing, using lettered columns and numbered lines. If there are several accounts which are part of the summary, using 11 by 17-inch paper and colors for specific facts determined by the forensic accountant for the chart will be most helpful to the settlement master or the bench officer. For easy reference during settlement proceedings or in an evidentiary hearing where the forensic will provide testimony, prepare a chart to be used as demonstrative evidence that summarizes the tracing with references to page numbers and line numbers in the report. Because judges and lawyers are less familiar with accounting processes, in a voluminous tracing, A great demonstrative chart makes the difference between easy comprehension and the glazed-over expression which sometimes happen when a forensic accountant is testifying. Now back to the decision.
Joe's accountant first gathered and reviewed all brokerage statements for each account, so he could list and analyze all transactions. For each account, he determined whether each deposit or transfer into the account was separate property or community property, or some combination. If unknown, he treated the funds deposited as community property. Consistent with Section 760's presumption that assets acquired during marriage are community property, Joe's accountant characterized all purchases of securities as community property, to the extent community property funds were available in the cash portion of the account to make the purchase. Only when the community funds in the cash portion of the account were exhausted did he characterize an investment as separate property. If some community property cash remained in an account, but was insufficient to purchase the entirety of the securities acquired, he characterized the investment as part community and part separate property, in proportion to the amount of each used to purchase the investment. If he characterized the investment as, for example, 65% community property and 35% separate property, he allocated any interest and dividends from that investment using the same ratio.
It is important to note that Joe's accountant apportioned the interests of the separate property and the community property in the same ratio as the cash available. The resulting investment or purchase retains the same portions of separate property and community property and is still a commingled asset. Let's return to the opinion.
When and if the asset was sold, he divided the proceeds in the same ratio. If the proceeds were used for subsequent investments, Joe's accountant traced them in the same manner. He used the same process to trace and characterize all assets in all accounts. The bottom line is the community was credited with any securities purchased in an account to the extent that community funds were available in that account for their purchase. To the extent community funds were not available in the account at the time an asset was purchased, the asset was characterized as separate property. And the community received the benefit of any investment, including dividends, interest, and the sale proceeds, to the same extent it owned the asset.
In the ultimate division of the community estate, the separate property portion of the asset will be awarded to the separate property owner spouse. The community property portion will be divided equally between the spouses. However, because the value of the securities is easily determined, a court, when making the global division, may award unequal amounts of specific securities to the parties, even to the point of awarding the entire community portion of a specific security to one spouse in order to achieve an overall equal global division.
Cash withdrawals, which are discussed further below, were deposited in the couple's community bank accounts, or, after separation, into an account Joe opened in his name. The withdrawals were treated by Joe's accountant as community property, and there is no evidence that the proceeds were used for any purpose other than family living expenses or community investments other than securities. Joe's accountant concluded that, at the end of 2014, the combined account balance in the investment accounts was approximately $6.9 million, of which $3,791,653 was Joe's separate property and $3,118,916 was community property. The trial court ruled Joe's tracing is an appropriate tracing, and Joe carried his burden of proof to trace his separate property through the commingled accounts. The trial court also adopted the findings contained in the tracing and associated schedules. The presumption that all property acquired by either spouse during the marriage is community property may be overcome. Whether or not the presumption is overcome is a question of fact for the trial court. In Marriage of Mix, 1975, where funds are paid from a commingled account, the presumption is that the funds are community funds. In order to overcome this presumption, a party must trace the funds expended to a separate property source. This issue presents a question of fact for the trial court, and its finding will be upheld if supported by substantial evidence.
The citation of the specific language in Marriage of Mix is important. It uses the term commingled to describe the account, not mixed.
As discussed below, DeeDee argues California law permits only two methods of tracing to overcome the presumption that property acquired during marriage is community property: direct tracing and exhaustion tracing. She contends that the trial court's adoption of a tracing method that failed to meet the requirements of either established standard was erroneous as a matter of law. Because this is a legal issue, or a mixed question of law and fact, in which the legal issue predominates, we review it de novo. DeeDee doesn't dispute any of the factual elements of the tracing prepared by Joe's accountant. As she says in her reply brief, here, there simply are no material contested facts. Instead, she contends the tracing is invalid as a matter of law because, 1, it differs from what she asserts are the two exclusive methods of tracing under California law: direct tracing and exhaustion tracing. 2, Joe did not prove he intended to use separate property funds to purchase any particular asset, and 3, Joe's accountant assumed assets were purchased with separate property funds whenever no community funds were available in the account in question, but Joe did not prove that community funds were not available in some other account. We disagree with her conclusion that Joe's tracing method was invalid as a matter of law. DeeDee correctly notes that previous reported cases have described two tracing methods. 1. Direct tracing can be used to demonstrate a spouse's separate property was used to purchase an asset, even though the purchase is made with funds from a commingled account containing both separate and community property. It requires a. Documentary proof that sufficient separate property funds were available in the account at the time of purchase, and b. Proof that the spouse making the purchase intended to use separate, rather than community funds. Exhaustion tracing is sometimes also called recapitulation, family expense, family living expense, or family income exhaustion tracing. Whatever the name, it attempts to trace a payment or purchase from a commingled mass to separate property funds by process of elimination, i.e., by showing that, because all community property funds were exhausted at the time the purchase or payment at issue was made, separate property funds necessarily must have been used. This approach presumes that available community property funds are used for family expenses before separate property funds are used for that purpose. See, for example, Marriage of Frick. As discussed below, we disagree with DeeDee's assertion that Joe's tracing method is wholly unprecedented. But even if, as DeeDee asserts, the two methods described above were the only ones previously described in the reported cases, that would not mean, as DeeDee repeatedly asserts, that they are the only methods permissible under California law. DeeDee cites no authority, and we are aware of none, holding that California law precludes trial courts from relying on any tracing method other than the two just described. The closest she comes is her citation of a passage from in Marriage of Stoll, 1998. It is Hornbook California family law that tracing is done either directly, or by a process of elimination whereby a spouse shows the exhaustion of available community funds at the time of acquisition. She also cites Mix, which employs similar language. Postmarital property can be established to be separate property by two independent methods of tracing. The first method involves direct tracing. The second method involves consideration of family expenses. Neither Stoll nor Mix prohibits variations in tracing methods to account for varied factual scenarios. These courts simply did not consider the propriety of any alternative tracing method, including Joe's method. The issue was not before them. We see no reason to straitjacket trial courts by adopting DeeDee's prohibition of tracing methods other than the two she identifies. Tracing is simply a method of proof. As noted above, trial courts have the flexibility to consider any credible evidence and to evaluate alternative tracing methods to determine whether the proponent of the tracing carries his or her burden of proof. The tracing method may vary depending on the facts. Thus, trial courts are free to consider and credit reasonable, well-supported, and non-speculative expert testimony. When determining whether the proponent has successfully traced commingled assets to a separate property source. Moreover, in reality, Joe's method of tracing separate property to and characterizing the activity within a particular commingled account is not unprecedented. In Cochran, a husband sought to trace his separate property funds paid out of a commingled bank account. At the time of the deposit, $43,061.24 was separate property and $34,405.51 was community property. The husband then wrote 3 checks. The first, for $34,192.15, paid off the balance due on a community property debt. The court concluded, based on the presumption that community living expenses are paid out of community rather than separate property, and because this was the first expenditure, that community funds were used to pay this debt. Thus, the first check exhausted the community property funds in the account, with the exception of $213. The court concluded, by process of elimination, there being only $213 of community property funds left in the bank account, the husband's separate property funds were used for all but $213 of the second and third payments, and he was entitled to reimbursement. The trial court knew Joe's tracing did not fit neatly into either of the 2 categories described above, and it combined some aspects of each. And Joe's tracing was far more complicated than the tracing in Cochran. Nevertheless, the trial court found the tracing was appropriate, sufficiently traced the accounts, and that respondent carried his burden of proof with respect to the marital tracing. The trial court correctly concluded that, unlike in a traditional direct tracing, the presumption employed by Joe's accountant, that all investments were community property until no more community cash remained in the account, rendered Joe's intent irrelevant. The tracing gave the investment opportunity first to the community, by characterizing all investments as community property whenever sufficient community property funds were available in the account to purchase the securities.
The fact that Joe's accountant gave the investment opportunity first to the community acknowledges the fiduciary duty of a spouse during marriage to enable the community to participate in an investment opportunity if the community is able to do so. Only when the community did not have sufficient funds to participate did Joe use his separate property for the investment.
But, whenever the community property funds in an account had been exhausted, by process of elimination Joe's accountant characterized the remaining funds as separate property, because only separate property remained in the account. Thus, he characterized investments made from those separate property funds as separate property. This is consistent with Cochran. DeeDee asserts Joe was required to demonstrate no community funds were available in any account before a purchase could be characterized as separate property, but that confuses the nature of Joe's tracing with a traditional exhaustion tracing. The 2 are not the same, as the trial court recognized, and their requirements differ. In this case, the commingled funds were in a number of separate, identifiable investment accounts. Joe had the burden to trace his separate property through each of those various accounts.
It is important that counsel for the tracing party understand the difference between a true exhaustion tracing and tracing through each individual account. Accountants do make that distinction, but it is counsel's job to present the legal distinction clearly to the settlement neutral. Justice Curry clearly distinguishes between them.
That there may have been community funds available elsewhere, whether in another investment account or in one of the couple's community bank accounts, was irrelevant to the tracing because it would not have altered the characterization of the funds inside any given account. And unlike community living expenses, which are presumed to have been made with community funds if any such funds are available anywhere, Cochran teaches us there is no reason to presume an investment made from a commingled fund is a community asset if, through tracing, it can be demonstrated that all community funds in the account were exhausted before the investment was made. Here, as reflected in the statement of decision, after considering the entirety of the evidence, the trial court found Joe carried his burden of proof with respect to the marital tracing and the court adopted Joe's tracing. We conclude substantial evidence supports the trial court's findings. The findings are consistent with the rule, discussed above, that separate property that has been commingled with community property does not lose its separate property status, so long as it can be traced back to a separate property source. The trial court adopted Joe's accountant's characterization of the parties' assets as of the date of separation, as reflected in Exhibit E to the Statement of Decision, and his schedule of known assets/liabilities and proposed division as reflected in Exhibit F. These findings also are supported by substantial evidence.
I have been using this method of tracing to determine character of assets for many years. It is very helpful to know that this method now has the authority of case law to support it.